62% of S&P 500 index companies have reported first quarter 2016 earnings as of the end of April. Expectations at this time are for yet another quarter of sales and earnings contraction, with growth not expected to resume until the second half. Excessive optimism has been a consistent theme for more than a year. In this Earnings Insight series, we focus on trends in S&P 500 index revenue, operating margins, and earnings. We want to pay special attention to real and recurring drivers of growth while looking past accounting-related practices. In our March Earnings Insight article, we mentioned the silver lining for 2016. Contracting 2015 earnings lowered the bar for 2016 growth, but there are three potential problems: excessively optimistic earnings projections, excessively optimistic stock market valuation, and excessively optimistic growth priced into the market. The market looks forward, basing its price today on expected future growth less some margin of safety. The danger is when the market becomes excessively optimistic at the risk of a correction. Earnings projections looking forward 4 quarters to 2014 had been quite accurate, averaging less than 5% above actual results. However, projections for the recent 5 quarters have overshot at an alarming rate. Full year 2015 earnings estimates were 30% off the mark. That's excessive optimism. According to FactSet Research Systems, the market has been punishing earnings misses more than it has been rewarding companies who beat expectations. Companies which reported upside surprises gained on average only about 0.4% over the 2 days before and after releasing earnings, while those who reported downside surprises averaged a 2.9% loss. When the market disproportionately punishes downside earnings surprises, it is indicative of overvaluation. Case in point, S&P forward operating price earnings ratio, or PE, has been running above its 2007 peak since 2014. A good example of expensive valuation is Netflix, which dropped 13% after beating estimates by more than 60%. Sales have been growing about 25% per quarter for the last 2 years, but as reported earnings have contracted on average 47% for the past 4 quarters. And in terms of PE, Netflix is priced at more than 19 times the S&P, and that's after declining 32% from its December highs. 2016 operating earnings estimates have dropped 11% in just 7 months. Assuming current projections were to materialize, growth would clock in at 15% above last year. Is it possible for the S&P to generate $115 per share by year's end? Well, either sales have to increase or margins have to expand. Given recent trends in margins, sales would have to grow by an average of 9% per quarter. But a more likely outcome is a reversion to the mean of 2.2% revenue growth, in which case margins would have to expand to 10%, the highest level in over 20 years. But even if sales growth resumed, and if margins expanded as described, projected 2016 growth may already be priced in at current levels. My mother used to say, "If was planted, but nothing grew." At Coherent, we aim to provide you with original analysis and opinion. I encourage you to visit our website for more articles and insights into today's markets, including a full version of this presentation. You can also find us on Facebook, LinkedIn, and Google+. My name is Sargon Zia. I am a Chartered Financial Analyst and Chief Investment Officer at Coherent Financial Advisors. Thank you for watching.